Hey guys, Corey here. Today we're going to be talking about covered calls, and my intent is to make this the last covered call video you will ever have to watch. It's going to be packed with all kinds of information, so strap in because we got a lot to cover. Number one, what is a covered call? Number two, what can a covered call do for you? Number three, what are the benefits of a covered call? Number four, what are the downsides of a covered call? And number five, how to properly implement a covered call into your portfolio. Hey guys, Corey here. Welcome to the channel. If it's your first time stopping in, be sure to subscribe and tap the bell. This way you don't miss any videos. And if you give me a thumbs up, that would be greatly appreciated as that helps the channel grow. If you like the strategies that I teach in this video and you want to learn even more, you can join my one-on-one coaching, Discord, and full training course at any time at investwithcorey.com/learn right on the screen or in the information box below. However, I am limited on spots. So if you're serious about your financial freedom and want to improve it, I would love to have you, as I take a lot of pride and passion to help others better their life. So let's jump right into covered calls. But first, I just want to point out that I'm not a financial advisor and this is not financial advice. I'm just here to give you guys tips, strategies, technicals, fundamentals, financials, and overall guidance in the market. However, it's ultimately up to you to manage your risk in your portfolio and to decide which stocks you want to put your money into and how much of a position size in those stocks you'd like to have, is it's ultimately your money. All right, guys, time to strap in. Let the knowledge begin. Number one, what is a covered call? Well, a covered call is a contract that the seller writes. It's a derivative that is used against an asset that you currently own. You write this contract so that a buyer may purchase it for a fee or a premium. This premium is paid to you, the seller, leveraging the asset or the underlying stock that you have, giving the buyer the right, but not the obligation to buy that asset if the underlying asset goes above the strike price of your short call position, covered call, that you have sold. As the seller, you are obligated to sell this contract if it expires in the money. In the money basically means that the stock price has risen above the strike price of the covered call. As an example, if Tesla's at $180 and you sell a $200 covered call, Tesla goes above $200 to say $205, you would then be forced to sell your shares at $200 even though the stock has risen to $205. A covered call is a very good strategy to use to implement into your portfolio to cap downside and to generate profits when a stock is range bound or bar coding, or you could say consolidating left to right with no real movement up or down. Covered calls benefit the most on a stock that consolidates, goes up slightly and then comes back down, or slightly goes down over time. But typically the best scenario is a stock that consolidates within a range where you're not losing really any money on the stock, but you're able to continue to sell covered calls over and over again. A covered call is also great to be utilized in a situation where you enter a stock at such a price and then you decide how much of a profit you'd like to take and start selling covered calls at a certain strike price that you would like to exit the stock. For example, if you entered Apple at $170 and decided I want to get $180 for my shares and I'll be happy to exit, you would sell $180 covered calls, and once the stock price goes above $180, you would get assigned, you would sell your shares at a profit. You would make $10 per share plus all of the premiums combined that you collected until you were assigned. It could be the first week, the second week. There's no telling how many weeks this might add up, but all of the premium is yours to keep plus the profit. Number two, how can a covered call help you? Well, we sort of already went over this in part one. Quite simply, a covered call can help you by generating extra premium when a stock isn't moving. So if you invest into a stock and for 6 months it's going sideways and not a lot is happening, it can generate you a lot of extra premium. On average, depending on the stock, you can generate 20 to 50% or more per year in additional revenue by selling covered calls, and sometimes even more. Another way a covered call can help you is if a stock that you've invested in is going down slowly but surely, not a lot, but just continually going down, it helps you hedge risk. For example, if you purchased 100 shares of, say, Palantir, and it cost you $25 a share, and then the price drops down to $22, you've lost over $300 on your investment. But if you're selling continuous covered calls week in and week out for 2 months at $12 to $15 per week, then you've generated $120 roughly in 2 months. So you're no longer out $300, you're only out $180. $300 minus $120 is $180. Quite simply, the very boring and plain old stock investor won't make as much juicy premiums, will not make as much profits, and will not be able to hedge risk as appropriately as a covered call investor will be able to do. Number three, the benefits. We've kind of talked about this in number two, but ultimately the benefits are hedging your risk. Number two, generating extra profit profits. Number 3, allowing you to exit the stock more than what you paid. Like I said in the previous example, if you're in a negative position on the stock, collecting juicy premium from covered calls will make up for your losses on the stock. In the example of Palantir, you paid $25 a share at $2,500 total for 100 shares. The stock price drops to $23. You're now out $200. After 3 months of selling covered calls, you will generate roughly $180 to $200. You've made all of your juicy premium back. If the stock is consolidating left to right, you can generate more juicy premium. But the big factor here is if you paid $25 for Palantir and you decided to get out of Palantir at say $28, you would start selling $28 covered calls week in and week out for several weeks, maybe even several months. When the stock reaches $28 or higher, you will get assigned and you will sell those shares at $28, giving you $300 of profit on 100 shares plus all of the premiums you've collected. So if it takes 4 months and you end up collecting $240, you add the $240 to the $300 you profited on the stock, you are now up $540 in 4 months, which is about a 25% return. So if we times that by 3 to 4 times a year, you're looking at a 75 to 100% return. That segues us into our 4th section of the video, downsides. The downsides of covered calls, really, there's only one true downside, and that is capping your profits or your upside. So at this point, you guys can see that covered calls are reducing the downside risk, collecting extra juicy premium, and allowing you to get out of a stock more than you paid for it, while retaining all of that juicy premium for yourselves. However, there is one downside, and that is capping the upside, or the profits are being capped on the stock. A lot of people will talk about a lot of different theories and a lot of different strategies that go into this, and a lot of different advanced ways to explain it, like the Sharp theory for one, which I read in a book in college and I never touched it again. There's a lot of explanations that are necessary for you to read once and understand it, but they really don't have a whole lot of meaning in the stock market, at least not for the retail investor on a retail level, and definitely not going to help you as much as price action, as well as the order books, and just overall the fundamentals and the financials and understanding a company that you're investing into. So I want to keep this as simple as possible. The only real downside to a covered call is capping your upside. You buy a stock for $20, you sell a $25 covered call. On the date of expiration, the stock prices went to $40, but you still have to sell it at $25. Not a reason to really be upset. You profited $500 on the shares plus the juicy premium. You can also use my Hyper Theta strategy, which I teach in my course and one-on-one coaching, which you can join at any time if you guys are enjoying my tutorials and you like my teaching style, want to learn more and better your life and grow your financial freedom and wealth. You can do so at investwithcorey.com/learn right there on the screen or in the information box below. So you can use my Hyper Theta, like I said, which I teach in my one-on-one coaching and my training course. And what this will allow you to do is to continually use Theta or time decay to roll out in a special strategy that I created specifically to save your shares. So really, the only downside of a covered call is losing your shares at a profit, but you're not getting as much of a profit as the shareholder because your winners are capped because of the covered call. But with my Hyper Theta strategy, I can specifically teach you how to save your shares while collecting more juicy premium and not getting assigned. That's very tricky. It's for advanced one-on-one coaching. Way too much to explain in this video, but I just wanted to point that out. So really, the only downside is capping your percentages on a stock. But if you're running the wheel, selling puts to get in, then selling covered calls to get out, there's really no downside. Do not sell covered calls around earnings. I've seen this happen time and time again. You buy shares at $20, cost you $2,000, you sell a $24 covered call right before earnings, stock goes to $35, $1,100 of profit left on the table. However, you can't look at this as being a complete negative because you really can't go broke taking profits, right? I mean, you bought it for $2,000, you sell it for $2,500 and the juicy premium. So you're not really losing. And I teach this in my coaching as well. Never get emotionally attached to the stocks you own because you cannot go broke taking profit. And I've seen a lot of students do this in the past, and it's a really bad thing. You get emotionally attached to a stock, you pay $20 a share, it goes to $25, your covered call is in the money, which means the stock price is above the strike price of your short call that you sold. It's going to get assigned, you're going to get forced to sell it. So you roll out a month and up to 27 or 28, and then the stock price plummets to $19 or $18, which is good for your short position because it decayed completely worthless, but now you are in the negative on the stock. So you have to be very careful not to hold your stock too long in case it falls back. Unless you plan on holding more than 3 to 5 years, I wouldn't worry about it. I would get assigned, then I would just sell puts to get back in. Okay, I want to show you guys an example of how a covered call can hedge your risk and what they mean by capping your upside or your profits. So on this chart, you can see we have a stock X, no name, $100. We're selling a covered call for $110 and collecting a $5 premium. So the simple stockholder is going to be black on this chart. This is $100, $110, $120, or $90 and $80. That's where the stock price is going. This is the profit chart, positive or negative. So if you buy 100 shares and the price stays at $100, you're at zero. So we go over here, $100. The simple stockholder is at zero. Okay. Now we're going to go to green. For the person that sold the covered call, it's collecting $5, so we'll put a dot right here at $5. Now, let's say stock goes down to $90. We are going to draw another dot down here, $10 negative for the shareholder right there. And at $90, the shareholder has lost $10 per share. On the $100, the option sellers made $5. So now that the stock has went down to $90, we're going to draw a dot for the covered call. It's going to be at the $90 mark, but it's going to be at -5, which is right here. Okay. So now instead of losing $10, we've only lost $5 because we collected $5 juicy premium. So now the stock continues to drop. The stock now goes to $80. The shareholder is now out $20. So here we go. Shareholder is right over here at 80 at $20, whereas the option holder that sold this contract for $5 is only -15. So we go over to 80 up to -15 right here. Now, if we can see this clearly, we see a pattern. I'll draw the line like this as best as I can. Then the stock. So what do we notice here? We notice that, let me fix this over here. My bad. We notice that the stock goes to 90. The shareholder loses 10. The option seller selling the covered call only loses 5. If the stock goes to 80, the shareholder loses 20. The option seller with the covered call only loses 15. If the stock stays the same, you make no money as the shareholder, 0. But if you sell the covered call, you make 5. So from 0, no matter how low we go, the trader or the investor that sold the covered call derivative against their asset or the stock is always going to lose less money. No matter how little it might be, it's still less because you're selling a covered call. What happens if the stock goes up? Well, let's say the stock goes to $105. The shareholder has now made $5. So we'll go right in between here, $5. That's where the shareholder is going to be. And the trader that sold the covered call is going to be up here because the price moved over to $105. But he's now up $10 because he collects 5 plus the 5 from the juicy premium, which puts him up to $10 right here. $10. If the stock price was to go to 110, the shareholder would be up $10, the boring old shareholder or investor. So we'll go up to 110 right here. This is now the shareholder's line right here. If we now look at the trader who sold the covered call, he's in the same position. Stock goes up $10. He collects 10 plus 5, which is 15. So he would be up here. All right. We're going to put 15. So in this situation, until we hit the strike price, which is 110 right here, the individual that sold the short call, the covered calls on their underlying asset or stock, is always ahead. In every scenario, no matter where you go, selling covered calls puts you ahead. If the stock, however, was to go to 120, the shareholder would profit at 120. The shareholder would make $20. On the $110 call option that was sold for $5, you're going to get assigned at 110. So even though the stock price went to $120, the most that you can collect is 110. So you can no longer make any more money. So at 120, it's capped like this. Okay, so there we go. So the stock price can keep going, as you guys can see. It can keep going like that. But we can't make any more money on the covered call because once it's in the money and the stock price is above 110, we're not able to sell this stock for any more. So what basically happens here is we made $15 right here in the profit, $15 right here at the 110 mark. But no matter where the stock goes, we can get a sign now because it's in the money. This is what I was explaining earlier about capping your upside. But quite simply, it's not a bad bad thing because you paid 100 right here and you're getting out at 110 plus the $5 premium. So you're making $15 per share. Not a bad way to look at things, right? Pretty positive. Another thing worth mentioning is you can sell covered calls against leap options, long, deep in the money call options that you've purchased 6 to 8 months out or more. But that's for a different video, and I will definitely put one up on YouTube real soon on that. But it's another one of those advanced strategies I also teach. So using Robinhood as an example, this is kind of how I would gauge doing covered calls. Let's say you sold puts or you just bought the stock on Robinhood around $17 or $18 down here. You would start selling $21 calls up here or 20. And as the stock goes up, you would roll out and up if you could manage to do so. And if you could, then you end up getting assigned up here somewhere at $22, and all of this profit is yours plus the juicy premium. You kind of have to gauge the movement of a stock. As we can see, it's starting to come back. It's a pullback right now. So I would start selling cash secured puts down here around $20 or $20.50. And as the stock comes down, I will roll out and down so I can come down to maybe $19, and then I'll get assigned. And then as the stock bounces and goes back up, I'll start selling $21, $22 covered calls again, get assigned, and make juicy premium and profits on top. So as an example on GameStop, let's say you got into GameStop today for $25 a share. You paid $2,500 for 100 shares. Then you would just go out the next week, June 28th, 1 week, click sell call, and then you'd pick a price that you are comfortable selling the stock. However, because this stock is volatile and moves pretty quickly in any one direction, quite a bit, I wouldn't want to lose a lot of profits or leave it on the table, but I also need to hedge my risk on the downside. So I wouldn't want to go up to say $35 and only collect $80, because then if the stock drops to 22 or 23, I'm losing $200 and only collecting $80. But at the same time, I wouldn't want to sell a $26 call option for $200, which protects the downside, meaning the stock could drop to $23 and I still don't lose money because I collected $200 juicy premium. However, if the stock goes to 40, I only make $100 in the shares because I'm capped at $26. So we have to find the middle ground. And if you're afraid the stock is going to go down, then you get more aggressive. You'd sell at 26 or at 27. If you think it's going to go up quite a bit, then you want to move further away. But in the example that the stock is going to move pretty high and we don't want to lose a lot of profits, we would go up to 29 or 30. We would make $124 juicy premium for this week. And then if the stock price goes to say 35, we would sell for 30. We would make $500 plus the 124. Not bad. $624 profit on $2,500 in 1 week. That's about a 22% return, 23% return in 1 week. That is insane. If we look at a chart, we feel like the stock is somewhat bearish, then we would sell a 25.50 or a 26, which would give us a lot more premium to collect in case the stock goes down. So if the stock does drop to 22 or 23, we're only losing $100 or we're breaking even, and we'll sell another $26 covered call going out another week. And what that will do is generate another amount of juicy premium for us. Covered calls are very powerful. So you can see covered calls are really not that hard to understand, especially if you're given examples and a full explanation and diagrams to show you in detail, start to finish, exactly what they do and how to use them. If you like the style of my coaching and enjoyed the strategies that you saw employed in this video, and you would like to learn more, expand your knowledge in the stock market, and become financially more profitable and financially free, you can do so by signing up for my one-on-one coaching, Discord, and training course at any time at investswithcorey.com/learn right there on the screen or in the information box below. I would love to have you. I'm driven and passionate about teaching others and helping you grow your wealth and become successful. So if you're serious and you're driven to learn, I would love to have you. You guys can sign up at any time, although spots are limited. I'm also launching my exclusive boot camp. Only 10 spots are available for that. So if that interests you, you can also sign up on my website as well. I hope to see you guys and would love to help you. But until the next video, be sure to subscribe and tap the bell so you don't miss any content, and give me a thumbs up as it greatly helps the channel. However, before you go, I got another video just for you and you are going to love it. And that video is right here. You guys are going to love that video, so check it out. I'll see you over there. And remember, until the next video, let's grow our wealth together. Take care, guys.